northeast wind. Overnight, mainly cloudy and cool and breezy. Temperatures by morning about 44. And tomorrow, gray skies are in. There could be a few showers around, maybe some mist. It'll be windy. Temperatures near 50. Then rain moves in with a gusty wind here on Thursday. On the Money Matters Radio Network, I'm Mark Rosenthal.
Hey parents, you don't need the latest gizmo, slang, or clothes to be a perfect parent, because kids in foster care don't need perfection. They need you. For more information on how you can adopt, go to adoptuskids.org. A public service announcement from the U.S. Department of Health and Human Services, Adopt Us Kids, and the Ad Council.
While retinitis pigmentosa takes Mark's vision, his family gives him hope, whether at the family business or at home with his wife and sons. He knows he's not fighting alone. For 50 years, the Foundation Fighting Blindness has funded research into treatments and cures for blinding retinal diseases, providing hope to people with vision loss. And for Mark, winning the fight means being there for his family. The Foundation Fighting Blindness. Together, we're winning. Help us end blinding diseases at fightingblindness.org.
This is WBNW 1120 AM, the Money Matters Radio Network. This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM, Concord, Boston, the Money Matters Radio Network.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, the grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Mark comes from a proud military family, including his father Victor and his brother Timmy. Mark talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Mark is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Mark, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Mark Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we've got a guide available this month titled Understanding Required Minimum Distributions. Mike, a lot of changes in the RMD landscape. When do people have to take RMDs from either IRAs or Roths?
How old are you?
Me personally?
So this does start changing now. It is currently 73 for a lot of folks. For some younger folks, it's actually now going to be 75 years old for your traditional IRAs and 401ks. And so that started at 70 and a half just a few years ago. And so this is a new set of rules for a lot of people.
When you look at how the penalty situation has evolved, this is one area that's actually gotten a little bit more lenient in recent years. And so that's something where if you are new to RMDs, there are some incentives if you've missed one to get that squared away as soon as possible.
There are, but, key takeaway. Understand these rules and don't miss your required minimum distribution, because there are still penalties for something that, again, is completely avoidable. Yes, the penalties used to be bigger. They are less less stringent now and a bit smaller, but it is still unnecessary extra taxes and fees that you will end up paying if you do miss your required minimum distribution. So get our guide and learn a little bit more about how all of this works.
Folks, the guide is titled Understanding Required Minimum Distributions, and there are two ways that you can request it. The first is by calling 800-393-4001. The second is by visiting ArmstrongAdvisory.com. Again, that number is 800-393-4001, or you can request it online at ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We pride ourselves on being able to support veterans in their time of greatest need, ensuring they receive the protections they deserve. For over 100 years, the DAV of Massachusetts has helped thousands of veterans with housing, transportation, and medical assistance, and you can help too. Please visit dav5k.boston and make a donation today. That's dav5k.boston.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Good morning, happy Tuesday. Welcome to the Financial Exchange. It's earnings week and Fed week here on Wall Street. We've got big earnings reports, especially coming tomorrow. But today we do have Visa reporting after the bell. United Health Group, Novartis, NextEra all reported before the bell today. We've got layoff announcements from a couple of big companies, actually, but Amazon making the biggest splash. And then the Fed has entered their closed-door meetings today. They will be doing their press conference and what Chuck and I deem to be probably one of the most boring Q&As out there for the Fed tomorrow, because they're going to be asked questions like, how do you know this without government data? And they're going to respond, we don't really know without government data, but here's what we think. So they are very likely, the Fed, to cut rates at the next coming meeting. We'll have a little bit of Fed talk as well. But the starting piece from the Wall Street Journal this morning, the good vibes back on Wall Street. To be fair, the good vibes only really took a halt for like a week and a half here when it comes to Wall Street. But here's what they are referring to, I think specifically, was the vibe change on October 10th. And on October 10th, that was a Friday. That was the day that President Trump hit Truth Social up with a post about China and their rare earth material restrictions, said that he was going to cancel the meeting with President Xi in, where are they meeting? I don't even remember. Korea?
South Korea, I believe.
Yeah, okay. He's canceling the meeting. He was going to impose 100% tariffs. Market sold off 3% that day. We were also in the midst of digesting some really new information when it came to the private credit industry, and everybody talking about how the Tricolor failure, followed by the First Brands failure, was going to send a reverberation into markets. And lo and behold, at the time, I want to pat our own back here for a moment, because at the time, when it came to the tariff stuff, at least, we really looked at that and said, what has changed here? Mm-hmm. Right? Like, nothing has changed here. These two countries are posturing ahead of a meeting, and all they are doing is announcing these things so that they can then wipe them away at this big meeting that's coming up. And so, therefore, there's nothing really happening here, and you shouldn't get overly concerned about it. It's not to say that it can't boil over, but I'm very much on the mindset now that until you actually see China completely cut off rare earth materials into the U.S. and until you see us retaliate with 100% actual tariffs being collected, we got to stop sweating it.
We've built up some callous since April, where it was raw and new, but now we're a little more seasoned into how this game goes.
So you saw that sell off initially. Things have rebounded. I guess my point, though, would be markets have clearly turned more optimistic. The good vibes are back, if you will. We're into earnings season. That has the ability to boost the vibes even further potentially this week. But important to consider here that neither of those things that set this off have been resolved in any way. We don't suddenly have a new realization about private credit that all is fine and the bad weather has passed on private credit. No, that is still a lingering issue out there. And the relationship between the U.S. and China has not resolved and probably will not during the Trump administration would be my guess. My best guess as to how things resolve with U.S. and China is this uncomfortable coexistence where we both realize that we can dramatically harm each other's economies and just don't really move the status quo on any of that. And that's fine.
I would agree the tension's not going anywhere, but there is potentially a catalyst from them making a deal, and the meeting's coming up soon. I think it's in the next couple of days here. If they're to make further progress on a deal, I don't think that fixes everything, but it certainly would add to the quote unquote good vibes.
Best case scenario, you get a deal on TikTok and a commitment to buy a bunch of soybeans that they don't follow through on.
Probably.
Right? Like, what are we even talking about here? So, yeah, I mean, that is the best case.
Rare earth, commitment reinforced there, too.
Hey, we're not going to do the worst case thing, which also then completely throws into question the domestic industry for rare earths. But we'll deal with that when we get there. Other big news coming out this week. We have $15 trillion with a T dollars worth of market capitalization reporting just across 5 companies. 5 of the biggest companies in the world at this stage: Microsoft, Alphabet, and Meta, all reporting tomorrow after the bell. That's not to minimize the impact of companies like Boeing and Caterpillar and Verizon, who are also reporting, but they're just not in the same ballpark as those big 3. Thursday, after the bell as well, Apple and Amazon. Between those 5 that I mentioned, Apple, Amazon, Microsoft, Meta, Alphabet, $15 trillion worth of market capitalization reporting.
And probably close to 25% of the S&P 500 from a weighting perspective, maybe 20.
Probably more, because the top 10 represent 47%, I believe it is now. Right. And so, the only other big one that you have out there,
Nvidia probably at 6.5 to 7%. Yeah, and Tesla,
about a fifth. Right. I think that's a good measurement. A quarter to a fifth of the S&P 500 reporting earnings just over the next 2 days. So clearly, I think there's some optimism about that. Markets wouldn't have floated up by 1% yesterday if they weren't excited about big earnings coming out. What are you on the lookout for this week when it comes to earnings?
Well, I'm going to just pivot a little bit from that question for just a moment, because I want to mention something else that's been going on this week. That's
just answer your question with a question.
No, this is not a question. This is a statement. A lot of mergers and acquisitions activity over the course of the last week or so. Really, that is part of this good vibes thesis on Wall Street, that you are seeing a tremendous amount of companies agreeing to acquire one another or to merge together. And that is also something that plays into just overall market confidence, that you have a regulatory environment that companies feel pretty comfortable with merging here. On the earnings season, to go back to your initial question here in terms of what we're looking for, it seems like there is going to be a tremendous amount of scrutiny now on CapEx, capital expenditures. What are these big hyperscaler companies spending on their data center build? I think that's something that's going to be in focus. And what will probably segue us to the next story too is the labor market and sort of commentary there on where we're going to sit. Any type of AI improvements is also something that I think for the next 6 months to a year, there's going to be a tremendous amount of scrutiny from Wall Street and analysts to see if the products that are being released or utilized by some of these big tech names are making a significant impact from a productivity standpoint. And the easiest way to probably see it is more on like the cloud computing side. That's what they're going to be looking at this week, is growth in those segments.
Yeah, I'm very curious about just how much scrutiny investors are going to place on these companies. So far, there's been very little. It's fair to say, like,
just
scrutinizing what is actually being
done.
There's
just cheering left and right, really.
Right.
There's not a lot of...
and so that's what I'm interested in is, assuming these companies come out with another several $1 billion worth of CapEx and announcements on this, that, or the other, do analysts start to scrutinize, okay, and then what?
Not yet.
Not yet.
No, I don't think so. I think there's longer to run with that.
Let's take a quick break. When we come back, I want to talk a little bit more about these big companies and the swings in their stock prices and whether or not what feels extraordinary to a lot of investors is, in fact, extraordinary from these big companies. That and Amazon job cuts coming up next.
There's only one show that follows Wall Street's continued volatility. Keep it here all morning long on the Financial Exchange Radio Network. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping and the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Hi, this is Chuck Zada from the Armstrong Advisory Group. Required minimum distributions, or RMDs, may seem simple, but there's a lot more to them than just taking money out of your IRA. RMDs impact how much you pay in taxes, and they can push your income into higher brackets. And if you miss one, the penalties can be steep. They also affect how much your heirs actually get to keep, which makes timing and strategy crucial. If you have multiple accounts, it's important to know which ones you can combine and which ones you can't in order to help you avoid costly mistakes. Our new guide, Understanding RMDs, shows you how to navigate the rules, limit your tax burden, and plan ahead for your legacy. Request your copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Cushing & Dolan want to help you avoid costly mistakes when it comes to gifting assets to your children. Their brand new guide, Making the Most of Gifting Assets, shares crucial strategies to help you protect your legacy and your family. Many people think gifting is always a good thing, but if it's done the wrong way, it can create real headaches. Even well-intentioned gifts can cause complications if your children are dealing with financial pressure or legal issues like a divorce. The guide also explains how a major gift, like a home or vacation property, could come with hidden tax consequences that may impact your entire estate plan. Before you make any big moves, arm yourself with the facts in this new guide from Cushing & Dolan. Call 866-848-5699 right now to get your copy. That's 866-848-5699. Or request it online at legalexchangeshow.com. That's legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network.
Paul, are stocks more volatile than they used to be? That's really what we're asking with some of these pieces these days, right? Are stocks swinging more than they used to? How would you, I guess first things first, how would you go about even answering that question?
Well, the way that the Financial Times poses it here is they are using dollar values of market cap to try and assess or gauge that volatility. So just for listeners out there, market cap is just basically what Wall Street deems a company to be worth, and how they determine that is the number of shares out there that people own times the price that it goes for on the open market every single day. And so as a result of that, on the highest end, you get Nvidia worth $4.5 trillion. And in terms of what we've seen over the last 5 years, we've had the S&P 500 grow about 100%. And as a result of that, $100 billion today compared to the volatility of 5 years ago, it's easier to have moves of $100 billion in a day when that's 2% of what Nvidia's market cap of $4.5 trillion.
It's like when people tell me that the Dow moved 300 points and they're freaked out. Like, it's less than 1%. Folks.
Exactly.
That's less than 1%.
I hate dollar comparisons when you're talking about markets. I think it's much better to do it in terms of percentages when you're trying to use these basic comparisons. Now, this piece does go in and try and make some other points to why there could be more volatility, and those I can kind of get behind a little bit. There seems to be, similar to 2021, a lot more options activity. In fact, I believe we're seeing the volume of single stock options reaching the highest levels since that period. There is some frothiness in the market that could lead to more volatility, but it hasn't played out on a broader scale.
Yeah, I think beware of two big things: securitization and leverage. And we are seeing growth in both of these things, right? We talked about how there's now more ETFs than there are individual securities on the market. What does that mean? It means that more companies are finding ways to make money by securitizing things like single stock leveraged ETFs, like frankly, all sorts of different things, crypto and other exchange traded funds. And so I think be wary of securitization of more and more products, because that historically has led to big problems. But without high degrees of leverage in there, it's usually not been able to light a match that burns the whole thing to the ground. And so that's the biggest piece in my mind to watch out for is, hey, when there is a massive amount of leverage in any area of the market, that's a bit of a warning sign that if there's any bad news there, then it can come crumbling down pretty quickly.
Yeah, you take the stairs up with the market, but oftentimes it's the elevator down when you have a lot of leverage played in.
So Amazon, stock is not moving much on the news, but ahead of their earnings call on Thursday, they've announced a 14,000 corporate workforce layoff. There are apparently plans to cut up to 30,000 jobs. That would be roughly 10% of Amazon's white-collar workforce. Reminder, this does not include any of their delivery drivers or warehouse workers. We're specifically talking about the white-collar stuff. What is your... I was trying to think through, is there any way to read this in terms of the timing of the announcement right ahead of earnings?
I wonder.
My mind immediately went there, and so I won't be shocked if, for instance, they're trying to make this earnings call about AI productivity, or maybe it's a bad earnings call and they're trying to justify things.
That's where my mind ran to. I said, that seems a little pessimistic sign that they're trying to kind of throw this out before.
Yeah, but again, reading too much into that can be a bad move too, because sometimes what happens is a local newspaper gets word of the announcement, and they need to get out in front of it before, the last thing you want as a company is your employees reading about a coming layoff from, the New York Times rather than from their employer themselves. So there can be a number of different reads to this, and I don't want to jump to any conclusions on that. But what has been unique about this market rally and this moment right here is the discussion to me of expansion, right? There's been a huge push for expansion. There's been massive expansion of R&D dollars and clearly on AI. Usually, historically, when that's happened, it's been paired with an expansion of employment.
Mm-hmm.
Yeah, like we're embarking on this new project. We're going to need 10,000 new workers in order to do it, and look at how profitable it's going to be 5 years from now. This moment, because of the nature of the technology that everyone's excited about, has all been about how much can I cut staff, limit future employment, and still
make
grow.
more revenue. That is, to me, the macroeconomic point to make on this story about Amazon, is that there has been a tremendous shift, call it over, I guess, the last 3 or 4 years, really since the ChatGPT moment and the further enthusiasm regarding AI has just picked up momentum since then, that usually to strut your stuff as to how strong you are as a company, it was a tremendous flex to show that you're hiring thousands of more workers, because what does that mean? Growing sales, growing optimism in your company. And now, particularly in these Silicon Valley companies, but also in retailers too, you hear this commentary from financial banks and others, it is more sexy to sort of say, you know what, we're going to keep our headcount the way it is. We may trim for efficiencies because we believe that this technology with AI is going to automate a lot of work, and we're going to be able to make more money with the same headcount. So you're almost counterintuitively sort of punished in a sense by Wall Street for this idea of this old methodology of hiring new workers, which to me is fascinating, that shift.
The question to me is, are companies actually cutting headcount because they are being more productive? And specifically, they're being more productive because of artificial intelligence. Or I think there's clearly a productivity shift going on right now. We can measure that. We're also hearing rumors of, have you heard of the 9-9-6 schedule?
No.
9 a.m. to 9 p.m., 6 days a week. It's the work schedule of the Chinese tech worker.
Yeah, I've heard that.
The 9-9-6 schedule, there's big pressure among all companies, but especially any of those in the U.S. that are tied to AI, to push their workers to be more productive and hopefully be able to credit artificial intelligence. My question is, are we seeing a productivity boom across the workforce right now because people are more nervous about their job, they're putting in extra hours and just trying harder than they were over the last few years, in which case the productivity increase that we're seeing is not sustainable?
Mm-hmm.
Right? Like, you can't go from working 8 hours to 9 hours to 15 hours over the course of the next 5 years.
Right.
There's a limitation to how much productivity you will actually pick up in your job. You'll be capped out. Or are we genuinely starting to see some increases in productivity due to a new emerging technology that will drive a decade of further productivity and allow us to deal with the fact that we have a much slower growth in our population, and will allow countries like China to deal with the fact that they are literally seeing more deaths than they are births in their country right now? These are, again, unanswerable questions, and I don't feel like many people are really asking them or holding their feet to the fire on these questions either. It's just, oh yeah, we cut these heads and we were able to still grow revenue. Okay, show me the reality.
I've been looking for a piece, and maybe it is out there and it just hasn't come across my desk, that provides concrete evidence, maybe just to an individual business out there that is getting tremendous productivity enhancements from this new technology. Amazon,
the opposite exists.
Amazon,
MIT did a study where they basically showed that 90-some-odd% of companies that are implementing AI are seeing no increases in productivity.
Really? Amazon is a good example of a company that has benefited. I mean, if you look at some of these statistics in terms of the number of packages that they ship per employee, it was 175 back about 10 years ago. Now, per employee that they have within their warehouses, it's 3,870, just over a 10-year span. The amount of robots that they have, they are probably the epitome of the use of robotics and technology to their benefit on the retail side of things, just to how efficient that they've become. But that doesn't speak to the broader economy in terms of...
And it doesn't speak to what people care about right now, which is not how robotics are fixing things, but how artificial intelligence is making you more productive.
Right.
That MIT study, by the way, found that 95% of enterprise-level generative AI products failed to deliver measurable revenue acceleration. Still early days, but that's where MIT found us. Quick break. Full market recap is next with Wall Street Watch.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
Hi guys.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com. Cushing & Dolan know that gifting assets can be one of the most emotional and challenging parts of estate planning. Their new guide, Making the Most of Gifting Assets, can help you learn what to consider before making a major gift, like your primary home or a vacation property, and avoid unintended tax problems. Call 866-848-5699 to get your copy, or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. If you're approaching your 70s, you might be thinking about slowing it down, but the IRS is just getting started. Required minimum distributions, or RMDs, kick in starting at age 73. And if you were born in 1960 or later, that number jumps to 75. RMDs are more than just a box to check. They can impact your taxes, your income plan, and even what you leave to your heirs. If not done properly, it could mean big penalties, but getting them right might help keep your money working for you. Our latest guide, Understanding RMDs, breaks down how they work, when to take them, and strategies that may make them less of a tax headache and more of a financial opportunity. Request your copy today by calling 800-393-4001 or by visiting ArmstrongAdvisory.com. That number again is 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan, with their master's in taxation. And today we're talking about the implications of gifting assets away. Todd, if you're trying to protect your assets from the cost of long-term care expenses, what are the risks in giving your assets to a child rather than transferring them to an irrevocable trust?
Yeah, it's a very big difference, right? These irrevocable trusts that we do for Medicaid purposes, first and foremost, are incomplete gifts. So you're not actually making a gift at all when you put it into these trusts. But if you give it to a child, now you've made a completed gift. So, for example, if I gave away my house, and people do it, right? You are giving away the built-in gain in that house. You now don't have any control over the house. You can't sell it and buy another one if you want to move. You need the kids' permission for all of that. Plus, if you never sell it and you die, you've trapped the built-in gain for the kids. When they go to sell it, they're going to have to pay capital gains tax. Whereas if you keep it, you can control it, get a step-up in basis for the kids when they die, and still protect it from the nursing home through the trust. Either way, it's going to take 5 years. But gifting isn't always the answer.
Educate yourself about the implications of gifting your assets away. Request your free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699. That's 866-848-5699. Or you can request a copy on their website, LegalExchangeShow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Markets are modestly extending gains from yesterday's rally as the Fed kicks off its two-day meeting today, followed by a rate decision on Wednesday. Traders are also readying for a batch of big tech earnings and a potential China trade deal later this week. Right now, the Dow is up by just over 0.5% or 256 points higher. S&P 500 is up 0.1% or 6 points. NASDAQ up about 0.25% or 55 points. Russell 2000 down by 0.4%. 10-year Treasury yield flat at the moment, now at 3.991%. And crude oil is down 1.25%, trading at $60.54 a barrel. Amazon announced that it will lay off about 14,000 corporate jobs, marking the largest round of corporate job cuts in the company's history. Reports indicated Amazon's layoffs are expected to affect as many as 30,000 corporate jobs. Amazon shares are down slightly. Meanwhile, UPS shares are jumping 7% after the delivery giant posted better than expected third quarter revenue and raised its fourth quarter guidance. The company also said it has reduced its management workforce by about 14,000 positions so far this year, and its operational workforce by 34,000 positions. Elsewhere, Microsoft and OpenAI finalized a new agreement where Microsoft will get a 27% ownership stake in OpenAI, worth about $135 billion. Microsoft shares are up over 2% and has surpassed $4 trillion in market cap today. Apple also crossed that mark today. PayPal is up by 12% after the digital payments company beat third quarter earnings and announced a new e-commerce partnership with OpenAI. Wayfair surging about 20% after the online furniture retailer posted stronger than expected third quarter earnings. And after today's closing bell, we'll see third quarter results from Visa. I'm Tucker Silva, and that is Wall Street Watch.
Hey, those guys have just what you need.
Shut up. Did I say that aloud?
I find it to be a catch. What is the actual slogan? You've
Wayfair,
got just,
got
what,
just
I
what I need.
Okay, yeah. Pretty solid.
Give me just what I needed.
No.
Nope, different song.
That wasn't it.
Yeah. They should maybe
that is a song.
Do that. I'm aware it is a song.
I'm just singing that song.
Yeah, got it. Little Wayfair and...
I just wanted to sing that song.
Mashup.
I mean, if you can tell if you can tell a joke during break and then retell it on the air, then I can do that.
Yeah, fair enough. The Fed's $6.6 trillion test. Here's my thesis. Nobody has anything to write about regarding the Fed because they're going to cut by 0.25% tomorrow and there's no government data for them to digest. So instead, they're talking about their balance sheet because you got to write something about the Fed. It's the day before a meeting. So what do we talk about? Their $6.6 trillion balance sheet and the fact that it's about to be paused in terms of the runoff. So in order to explain this, so you have to kind of explain, I guess, how they came upon $6.6 trillion worth of securities over the course of the last few decades. So typically when we talk about the Fed, we're talking about the Fed funds target interest rate, which they set. And they don't set. They through open market actions, they attempt to put it within a range of interest rates. And that drives everything from your auto loan to your credit card interest rate to your HELOC and really drives those interest rates on the short end of the curve. In times of crisis, or frankly, even in times that I wouldn't really consider crisis, they have implemented different market actions, such as during 2008, during that crisis, and during 2020. And I was talking to Mark Fandetti today to make sure I'm describing this properly, but
failure.
Yes. Here is kind of how I would describe these market actions is it is the Fed's attempt to supply liquidity into the market and specifically to do something about longer-term interest rates. It's not direct yield curve control. They're not targeting to say, hey, we want the 30-year Treasury to be trading at 4% or 2%, but they are, by going out there during COVID and buying, what was it, like $45 billion a month in Treasuries and mortgage-backed securities, there's only one reason you do that, which is to supply the market with liquidity, dollars, and to make sure that rates on that stuff that could otherwise go crazy are staying within some sort of range that you are targeting.
And that you could credit for your 3% mortgages that you picked up back in
would not have been possible.
All the
refis,
refis, like that is kind of a almost direct correlation.
And so I feel like that confuses myself included people because we do talk about the Fed as, they don't really control long-term rates. Well, they can. They just usually don't do it unless it's a crisis.
They can try to influence them, as best they can with monetary policy. Sometimes that could fall flat, but in previous instances, they've been successful in being stimulative by these approaches.
And this was really kind of revolutionized by Bernanke, who kind of wrote about it a lot in the 90s and got the chance to implement it during the Great Financial Crisis and really put this to the test, and then was just kind of accelerated to a previously unforeseen level during the COVID crisis. But here we stand now with a Federal Reserve, a central bank with $6+ trillion sitting there in terms of securities. What they had been doing since 2022 has been not exactly selling them into the open market, but again, they're bonds. So at some point, those bonds mature. The Fed gets their dollars, and they've just not been going back out and buying new ones. That's what they mean by balance sheet runoff, is just saying, yep, the bond that matured, we're going to allow it to mature. We're not going to go take that cash and buy another one. We are therefore, sapping the market of liquidity a little bit. It looks like they are going to end that portfolio runoff very soon is where people are conjecturing. And in the context of where we are right now in markets, very slow job growth, concerns about private credit, concerns about some of the owners of that private credit, I think that is a reasonable policy choice. But it is just kind of wild to be sitting here and saying, yeah, with low unemployment, low inflation, a stock market that's hitting all-time highs, the Fed's probably going to be saying sometime soon that not only are we lowering interest rates, but we are going to continue to supply the market with liquidity by not allowing these bonds to just run off our balance sheet.
It seems really counterintuitive that we'd be wrapping up this cycle so quickly. To be fair, inflation has come down to a more reasonable target of 3% or so. And then on the liquidity front, like you mentioned, it's been in a little bit better place, but it's always a very difficult balancing act, and I don't pretend to know the intricacies of it. That Fed fund overnight rate is heavily influenced by the amount of reserves that the Fed has on its balance sheet, separate from the securities portfolio. So it's a really careful balancing act that they have to strike here in terms of when they end this runoff. But you introed the segment the best, where this is deep cut, sort of like that indie band or like that movie at like a Cambridge, small theater sort of chatter here when you talk about the Fed balance sheet. It's not the big boy stuff, which is the interest rate movements.
Yeah, I mean, frankly, I just feel like the Fed is stuck in this position now where they have a giant balance sheet and nobody fully understands, even at the Federal Reserve, what would happen if they continued to try and run it off. And so the safe thing to do is just to say, we're pausing. We're going to keep doing what we're doing. And yes, we own this gargantuan amount of securities and a huge balance sheet that we've never seen before. But as such, running it off when we have some concerns about the state of markets is too dangerous, so we'll let the next person worry about it. That's I kind of think where the Fed sits right now. Let's take a quick break. When we come back, Americans facing a retirement confidence paradox. We will talk about, what's the plural of paradox?
Paradoxes?
Yeah. We'll talk about paradoxes next on the Financial Exchange.
The Financial Exchange streams live on YouTube. Like our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network. Cushing & Dolan know that gifting assets can be one of the most emotional and challenging parts of estate planning. Their new guide, Making the Most of Gifting Assets, can help you learn what to consider before making a major gift, like your primary home or a vacation property, and avoid unintended tax problems. Call 866-848-5699 to get your copy, or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Hi, this is Chuck Zada from the Armstrong Advisory Group. Required minimum distributions, or RMDs, may seem simple, but there's a lot more to them than just taking money out of your IRA. RMDs impact how much you pay in taxes, and they can push your income into higher brackets. And if you miss one, the penalties can be steep. They also affect how much your heirs actually get to keep, which makes timing and strategy crucial. If you have multiple accounts, it's important to know which ones you can combine and which ones you can't in order to help you avoid costly mistakes. Our new guide, Understanding RMDs, shows you how to navigate the rules, limit your tax burden, and plan ahead for your legacy. Request your copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping in the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Miss any of the show? The Financial Exchange Show podcast is available on Apple, Spotify, and iHeartRadio. Hit the subscribe button and leave us a 5-star review. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you by the U.S. Virgin Islands Department of Tourism. Looking for a getaway that's easy, warm, and unforgettable? Discover the magic of the U.S. Virgin Islands, St. Croix, St. Thomas, and St. John. Just a short flight from New England with no passport needed and no money to exchange. Soak up the sun, stroll along white sand beaches, and feel the rhythm of the heartbeat of the islands. The USVI is America's Caribbean paradise. Plan your fall escape now at visitusvi.com. That's visit usvi.com.
So Paul, Prudential did a survey about Americans, and actually not just Americans. They surveyed folks from Brazil, Mexico, Japan, and the United States, specifically looking at 4,200 adults and their feelings about retirement. One, I guess, surprising piece to me, which I take as good news, is that 89% of wealthy U.S. adults said that they are confident they'd be able to cover essential costs in retirement.
Mm-hmm.
But only about half of them have actually factored in inflation to their retirement planning. So that's the paradox that they're calling, is they're basically saying that Americans are overly confident about their ability to retire and fund their retirements, which I guess, buy. I think such a bull market like the one that we have seen, frankly, over the last 17-ish years now, right? Since 2010 or so, or 2009 or so,
right,
we have seen just a straight line bull market that I think has lent a lot of confidence to folks. But it's a fair point that, yeah, when you dig underneath the hood, you start to raise some questions about where people are actually prepared or unprepared for their retirement.
The inflation piece is probably the hardest moving target because it is impossible to project. In our financial planning work that we do, it usually is the most sensitive one that can impact a client's plan. Is any changes in inflation, particularly if it's higher than projected, can really put a damper and a huge dent into someone's potential financial success.
I've said this before here, but I'll actually say that most people that I have met and had these types of conversations with are much more worried about a market crash, but much more exposed to higher inflation.
Sure.
So like the way that they're managing their own money, they're terrified of the market falling apart and completely underprepared for the idea that inflation could run 3% instead of 2.5%.
Exactly right.
Like such a small little tweak there. I think one of the problems, though, with our industry, we both work as financial advisors. We work in wealth management. I feel as though we have this kind of stodgy reputation for, they're just going to take my money and do whatever they want with it. And some people have a positive outlook with that, like, look how great they have done at managing money over the course of a decade. Others might have a negative outlook of it, but I think that's kind of the opinion of what financial advisors do, is they're here to take my money and allocate it properly. And frankly, if I'm looking at my own portfolio over the last 15 years and even did something very simple like put it all in some sort of balanced type of fund, I've probably done pretty darn well.
Mm-hmm.
And I think that's where some of the nuance comes in, and what we do a bad job of in our industry is actually explaining that, we have plenty of clients who have some of the best wealth managers out there. They can pick stocks, they can run a portfolio on their own, they don't really need our help, but they have no idea how to build a financial plan.
Right.
I've met engineers who are excellent at building spreadsheets and can model out their entire rest of their financial lives with a high degree of accuracy, accounting for things like inflation and market drops, but are some of the worst when it comes to assessing how taxes are going to play out with their plan. I've met tax attorneys who know the tax code in and out and can find every loophole for you and suck at investing. And so my point with all this would merely be there's a lot of places that try and do a one-size-fits-all approach. And that can be right for some people, but it's absolutely wrong for others. And I think especially, I'm seeing differences between generations too. I found older generations that really just want to outsource it all and just say, I'm not interested in this. I found a lot of younger generations who say, no, I am passionate about investing. I just need help here.
Mm-hmm.
And that's where, again, I think our industry could do a better job of explaining, like, there are financial advisors out there where if I just need somebody to take a look at what I've already done and give me a grade and tell me how am I coming along when it comes to preparing for all this, there are people that will do that. There are people that you can have on retainer and just pay an hourly fee. There are folks that will just manage your money and do nothing else at all. But we have this, again, reputation of, they want to do everything and take over everything. If you have questions about your own financial future and you fall into one of those categories of, I feel like I'm actually fine at these other things and could use a little bit of help here, or guidance on this, guidance on that specific issue. I can't promise that Armstrong Advisory Group can answer all of them, right? Like, we are not experts on everything. Nobody is experts on everything. But if you have questions like that and you want to kick the tires a little bit and understand how we work with our clients, give us a call at 800-393-4001. That's a number for the Armstrong Advisory Group. We have employees and offices scattered throughout the New England area, but we meet with people nationwide and be happy to chat with you too. The number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
At the open this morning, United Parcel Service, UPS, was up about 10% in early trading. It's calmed down a little bit. It's up about 7% so far in trading. What did we hear from the logistics and delivery giant, Paul?
Similar to what Amazon had talked about earlier that we covered in the show, UPS is also cutting 34,000 jobs in its operational workforce, and that's a 70% increase from its previous target. But also in terms of the reason why it's up so high today is it just crushed profit expectations, and there's more confidence in the couriers' comeback plans. UPS has struggled tremendously. Post-pandemic, they had a lot of momentum, but have struggled since then quite a bit. It's interesting. This mirrors sort of a conversation I had recently with a client who is a longtime employee of UPS who recently retired, who mentioned that the cost-cutting endeavors that they are embarking on are serious and significant. He was mentioning to me that they are really looking to cut headcount down, and this backs that up.
Yeah, you've seen it with the storefronts too. They are closing more of those. Frankly, the only time I ever enter them, actually there's two occasions. One is when I need to ship something to my family in the Midwest for usually Christmas. And usually it's my wife doing that, not me. Two, it's when I'm returning something for Amazon.
Right.
And that's convenient, but I don't know how much business that really generates for UPS. And so they're cutting these stores and finally seeing a bit of a break in what has been, frankly, a 3-year direct trend downwards for this company. It's trading at $95.50 a share this morning. It hit a peak back in 2022 of nearly $225 a share. Yeah. It has been a big fall for what has been, again, a huge logistics company, but they've been, I think, struggling to find their position ever since Amazon started to compete with them.
No question about it. That business is very challenging. The low-value e-commerce stuff that they were doing for Amazon, it's just been tough. And Amazon has taken a lot of it on its own and been a fierce competitor for them. It's incredible. The cost savings that they've achieved this year is about $2.2 billion for the first 9 months of the year. $3.5 billion will be the total year-over-year savings that they have. Stock was down, as you mentioned, 29% this year through Monday.
S&P 500 barely hanging on to some gains here. We've got it up about 0.1%. We're going to take a quick break. When we come back, we're talking private credit, among other things. So stay tuned, folks. We'll be right back.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
Did you outgrow your timeshare and now you want out?
but you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense. Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM. Concord, Boston, the Money Matters Radio Network.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping in the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all 3 and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Mark comes from a proud military family, including his father Victor and his brother Timmy. Mark talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Mark is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Mark, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Mark Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Understanding Required Minimum Distributions. Mike, one area with some big changes the last couple of years has been RMDs as it relates to inherited IRAs. What is the lay of the land today?
Yeah, so critical things that you need to know is that for most inheritors that are not spouses, so that's your starting point. If you are not married to the person who passed away, you are most likely subject to a out in 10 rule. What has also changed is that you're required to satisfy two different rules for most folks. Again, you are required to empty that inherited IRA within a decade. You also have annual required minimum distributions based on life expectancy. So it is really complicated now for inheritors.
How does that potentially influence how a parent may leave assets to surviving children in terms of taking their incomes into account?
Yeah, well, I mean, look, it is going to concentrate this additional income in a decade time period after you're gone. And so it adds a little bit of complexity in terms of that estate planning, right? Maybe I've got two kids. One's a very high income earner. One is a little bit lower. Do I potentially reshape my beneficiaries so that they both receive the same amount, maybe after taxes? A lot of complex planning you can do there.
The guide this month is titled Understanding Required Minimum Distributions. The two ways that you can request it are by calling 800-393-4001 or by visiting armstrongadvisory.com. Again, that number is 800-393-4001, or you can request it at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Good morning. Welcome back to the Financial Exchange. It's Mike, Paul, and Tucker with you on a Tuesday ahead of a big earnings week here. Tomorrow, after the bell, we are going to be hearing from Microsoft, Alphabet, and Meta themselves reporting, nearly $9 trillion worth of market capitalization. That's ahead of Thursday's big report where we will hear from both Apple and Amazon, who combined will be reporting more than $6 trillion worth of market cap. So big ability to move markets. That equates to around a fifth or a quarter of total market cap of the S&P 500. We've got announcements from the likes of UPS as well as Amazon, both of which have announced that they are making job cuts. In some cases, UPS already have made significant job cuts. On the UPS side, it's in the 30,000+ range. Amazon immediately planning some 14,000 job cuts with a potential for up to 30,000. The two companies, I know all of us kind of think of the two as linked in some ways, right? They are, shipping companies in a lot of ways, and we interact with them on a daily basis. They're cutting different areas. UPS is purely that logistics company. They're cutting drivers. They're cutting in-store retail locations. Amazon holding on to their logistics part of their business and really focusing on that corporate workforce that they are reducing here. But again, big announcement potential from all of these companies coming up this week with big earnings. We also have a Fed meeting that is already underway. We expect that they will be cutting rates tomorrow during their announcements at 2 p.m., press conference at 2:30. The press conference itself, honestly, it will be interesting just insofar as I don't know what you ask the Fed right now because they don't know the state of the labor market. They have some semblance of the state of inflation, but mainly I think they're going to be asked questions like, what will you do if the government doesn't open for another 30 days, which is interesting, but I don't know how impactful it is, right? There's no answer to it. What do you do if in 30 days the government's still closed? Well, we guess. Is the answer, right? Like that's what we do, and so they will have some answer on that front. But again, I think the Fed meeting is likely to not give us a whole lot of new information, nor should it, because the Fed is flying blind a little bit. Anything else catching your eye in markets or just big financial news that I missed this morning, Paul?
No, I think we hit on most of them here.
So I am interested in this next piece from the Wall Street Journal. It is from the opinion section of the Wall Street Journal. It's from an individual named Dan Wertman, who I had never heard of before. He's the CEO of Noetica, a market intelligence AI software company. Okay, got it. There's a lot of these different companies. He's the CEO of this one. And he writes about private credit and the winter that is coming. So take a step back, Paul. Talk to us about private credit and the prevalence in today's markets before we get into why it's heading for a winter.
So private credit has exploded over the course of the last 10 years. And when we're speaking about private credit, there is the public credit markets that if you're Intel or Walmart or AT&T, you can issue bonds that someone at any retail investment firm or any type of major custodian out there could purchase the debt that company has issued. Private obviously implies that you and I, Mike and Tucker and Paul, wouldn't have access to this funding. They're typically sourcing out funding from non-public markets, so that could be private equity firms, it could be endowments, hedge funds, pension
family
plans,
offices, largely bigger investors, though, who are going to grab up a lot more than $10,000 worth of a bond.
And it really jolted up when you had a period of time where interest rates were extremely low and you were looking for creative ways to be able to get a better interest from a debt perspective. Think about...
So the investors were looking for that.
Right.
And the borrowers, I think, were looking for a new source because their neighborhood bank that used to issue debt stopped doing so after the great financial crisis.
Exactly. If you look at sectors like the auto lending market, if you look at the biggest banks out there, Goldman Sachs, JP Morgan, Bank of America, not a lot of lending in that space. They don't really make a huge focus on it. So as a result of that, there was liquidity that needed to be taken up or debt issuance, and that was sort of absorbed by the private credit market. And it's been a tremendous run where there's been a lot of investment in that space. And what often happens in financial markets is there is enthusiasm and growth that outpaces really the regulatory environment. And as a result, you have situations occurring like we've seen with Tricolor and First Brands where the growth led to probably some unsavory business practices or fraudulent business practices. We don't know the exact specifics yet, but certainly it outpaced where the regulatory framework was, where there just wasn't enough visibility onto some of these loopholes that some of these companies, it seems, exploited.
Yeah, here are the pieces that there's a bunch that we don't know, right? Like how big all this is. Where does it all lie? Is it concentrated in any number of banks or insurance companies that would be really upset if this stuff started to blow up? What we do seem to know is that with the failure of Tricolor and then First Brands, the private credit industry seemed a bit blindsided.
Mm-hmm.
They were not aware of all of the different loans that were out there, the mechanisms that they used to try and control risk did not work quite as well in private markets where there's less transparency than in public markets. And it just grew so, at least according to the author, the private credit industry has grown so fast that the verification and audit frameworks, quote, haven't kept up with the lending. And so what the author points out is that since 2023, but really in the last quarter alone, there has been a good hard look at these loans on behalf of the lenders. And they're trying to, in a number of different ways, find the liabilities that are risky and close off the risk in some way, shape, or form to prevent contagion. And so he points out, I'm going to quote right from here, since 2023, lenders have started to close off liability management loopholes that make pandemic-era financing so risky. What those specific loopholes are, I mean, I think it allows you to shift debt from one organization to another without the lender being able to recapture some of that.
And move assets, too, that's backing behind some of the debt. But important to note that, like you mentioned, you hit the main point there where the lenders are kind of reclassifying some of those terms, basically to make sure that they can get paid if there's a result of a bankruptcy, making sure that they're high on that list of creditors who need to be paid back, and also that they need to have a say in sort of this bankruptcy process before any other companies kind of jump the ship here.
So by the very nature of private credit, it's right in the word, it's pretty private. We don't get a lot of visibility into what these lenders are doing underneath the hood and what the banks and insurance companies and endowments and everybody else that's buying this stuff are doing underneath the hood. But this is one of the first reports that I've seen that points to some specific numbers. For instance, terms requiring unanimous lender consent before any lien subordination jumped 23 percentage points in the third quarter and now appear in 84% of all credit deals. Again, we have no way of verifying this, which is kind of the concerning part, other than hearing it from the major originators and lenders themselves. But this, to me, is the first piece of reporting that I've been kind of keeping my eyes out for to confirm what I suspected, which is the lenders seem nervous.
Mm-hmm. He makes the parallel. Not to be clear, this isn't the size of scale of the housing market back in 2007, but similar behaviors where you saw loan documents sort of loosening months before some of the defaults picked up.
So again, how that will play out, over what time frame it will play out, and whether or not it blows up in anybody's face, open questions. Nobody has an answer to this stuff, but I don't think anybody's out of the woods yet when it comes to this entire market. We've got to take a quick break. When we come back, we're going to be joined by Martha Gimble. She's in the Budget Lab at Yale, and they're doing a study on AI impact on the labor market. We're going to be talking with Martha next on the Financial Exchange.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Subscribe to our page and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
Mark Vonner is the CEO of Veterans Development Corporation. His dedication to serving our veterans has made an incredible impact on his family and employees. And he is so proud to be the presenting sponsor of the DAV 5K Boston.
This is Brittany Vonner. I'm a registered nurse who is now working as an assistant project manager at Veterans Development Corporation. Working with my father, Mark, has been an incredibly rewarding experience. Our company is dedicated to serving VA hospitals and veteran communities. We don't just build facilities, we build environments that support healing, resilience, and family. We are so proud to see our work directly impact the lives of veterans and the professionals who care for them. This rich history is why we care so much about supporting great organizations such as the Disabled American Veterans Department of Massachusetts in the work they do to care for our veterans.
Join Veterans Development Corporation in thanking our great American heroes. Please visit dav5k.boston to show your support today.
The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping and the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Hi, this is Chuck Zada from the Armstrong Advisory Group. Required minimum distributions, or RMDs, may seem simple, but there's a lot more to them than just taking money out of your IRA. RMDs impact how much you pay in taxes, and they can push your income into higher brackets. And if you miss one, the penalties can be steep. They also affect how much your heirs actually get to keep, which makes timing and strategy crucial. If you have multiple accounts, it's important to know which ones you can combine and which ones you can't in order to help you avoid costly mistakes. Our new guide, Understanding RMDs, shows you how to navigate the rules, limit your tax burden, and plan ahead for your legacy. Request your copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, the grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
The Financial Exchange is now available every day from 11 to noon on SiriusXM's Business Radio Channel 132. Stay informed about the latest from Wall Street, fiscal policy, and breaking business news every day. The Financial Exchange is live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
This year's DAV 5K is sold out, but you can still help our great American heroes. The race is coming up here on Saturday, November 8th at Castle Island, and you can visit dav5k.boston to make a donation of any amount to support our troops. Your gifts help fund free rides to medical appointments for veterans and the nation's first DAV-led housing initiative, providing homes for single veterans and veteran families. Go to dav5k.boston and make your donation today.
The Budget Lab at Yale earlier this year was, I would have to say, the most cited source for research on the impact of tariffs in this economy, and really was the front runner in anybody putting together measurements there. The Budget Lab at Yale is now taking a look at the AI impact on the labor market. And we're joined by Martha Gimble from the Budget Lab at Yale to talk about the kickoff of their research and what they've been able to measure so far. Martha, thanks for joining us. Appreciate it.
Thank you so much for having me.
So what sort of methodology, I guess, do you try to apply to a question like, how is artificial intelligence affecting the labor market? It seems to be the express goal of AI, but I'm just curious about how you can even go about measuring something like this.
Yeah, I mean, to be clear, that is the million, billion, trillion, depending on where you think AI is going, I guess, question.
Right.
We tried to really take this back to first principles and think about what would you expect to see if and when AI starts really affecting the labor market. And so what we did was take existing labor market data, the labor market data that underpins a lot of statistics that many of you are probably used to hearing about the labor market, like the unemployment rate. And used that to look at how fast things are changing in the labor market, but also whether or not you're seeing changes in who is unemployed, who is employed, what that kind of looks like. And the sort of spoiler is you are not seeing big changes here yet. I think it sort of speaks to how fast this conversation is moving, that people expect to already be seeing employment impacts from AI. Technological change takes time. And I think our papers are an important reminder of that.
So I guess provide us some context. The biggest comparison point that I can make would be the internet. And I've said publicly that I think that this might be the biggest technological innovation since the internet. Do you have some measurement of how long that technology took to affect the labor market and what we in fact saw in terms of the impacts?
Yeah, I mean, the internet took time, and also it was gradual. It was not a major shock. And one of the things that happened because it was gradual was, yes, people lost their jobs. Yes, different skill sets became obsolete. But it happened in such a way that it was easy for people, I shouldn't say easy, it was easier for people to retrain. And new people coming into the labor market were able to move into occupations that were going to have kind of long run options for them. I think the internet is the version that a lot of people in AI are really hoping for, but they would say bigger. I think the version of this that scares people is the first industrial revolution, where you had a lot of weavers suddenly out of business. Now there are things that are different now, obviously, than are different about 1822, to state the obvious. But I think part of what people are still trying to figure out is, one, how long this is going to take, how big it may or may not be, and who it will affect.
Martha, when we talk about AI, obviously, companies like IBM have been touting artificial intelligence for quite a long time. When's the beginning point, according to the Budget Lab at Yale, for this? I mean, it feels like it's definitely been dominating news stories for the last 2 to 3 years. When's the beginning of your measurement, I guess, if we're going to try and guess at the impact of this?
This is such a good question. So we looked at specifically the launch of generative AI, particularly ChatGPT. Obviously, when we talk about AI, there's a lot of things that are kind of swept into that definition. And per your point, we are often a little bit sloppy in how we talk about this, and we put many different things under that heading. But we are specifically talking about generative AI, which is the release that I think caused a lot of people to start thinking, wait a minute, can AI do my job? Can AI do my employees' jobs? Are we going to start seeing some big labor market shifts here? And just to, kind of go back to the point at the beginning, not yet, right? It's really clear in looking at our data, and we are not the only ones who have found this, that there are not yet major impacts of AI on the labor market.
One of the places that this has been written about quite a bit is recent college grads. It's been written about the difficult labor market that they are facing as they are graduating, changes in what employers are looking for. Is that measurable, I guess, in this moment, that recent college grads are in fact facing a tougher labor market? And if not to be blamed on AI, is there another thing that it can be looked at to blame the struggle that recent college grads are facing?
So I think there's a couple of things that are happening at once. One is there are simply more people graduating from college than ever before. And so if you think about the competition for hiring college graduates, it's just not as competitive as it used to be because there are more college graduates, right? It's a pure supply demand issue. If you look at some of the worsening outcomes for college graduates, and I should emphasize, this is all relative, you are still seeing much more positive economic outcomes for college graduates relative to people who don't have a college degree on average. A lot of that predates this conversation. I mean, we're talking about things starting in 2014. There's another aspect of this, which is, I have joked repeatedly that I will never forgive Sam Altman for releasing ChatGPT in the middle of a Federal Reserve hiking cycle. But I'm sort of not joking. It makes it really hard to figure out how much of any changes are about technological change versus these sort of macroeconomic cyclical changes. 2022 was the middle of a Federal Reserve hiking cycle. We would expect the labor market to slow down. We would expect things to slow down, particularly for younger workers who are just coming out of school. Because if people stop hiring, that is going to most impact people who are trying to find a job for the first time. And so a lot of what we're seeing is almost certainly about the macroeconomic cycle rather than technological change.
Martha Gimble is the executive director and co-founder of the Budget Lab at Yale, and the most recent analysis they're undertaking is evaluating the impact of artificial intelligence on the labor market, and the good news there is it's going to apparently take some time to measure. Martha, really appreciate you coming on and would love to chat with you again as you release more stuff, so thank you.
Thank you for having me.
This she's right. This is the $1 trillion+ question, maybe $10 trillion question is, will there actually be a measurable impact? And to me, this echoes what we were just talking about with the MIT study, which is, to this point, it's too early to tell.
Right.
It's not to say there won't be an effect. It's not to say that it won't be this, that, or the other. But I especially take her point that we are seeing this happen at the same time that the Fed is trying to control the growth in the economy via interest rates. And so very difficult to measure whether or not, hey, is that an AI effect or is the economy just slowing and therefore unemployment increasing?
So much work to be done there, but it is the fundamental question, and it's great that companies are trying to tackle some research on it.
Quick break. When we come back, Wall Street Watch plus trivia is next.
Bringing the latest financial news straight to your...
Thinking about slowing it down, but the IRS is just getting started. Required minimum distributions, or RMDs, kick in starting at age 73. And if you were born in 1960 or later, that number jumps to 75. RMDs are more than just a box to check. They can impact your taxes, your income plan, and even what you leave to your heirs. If not done properly, it could mean big penalties, but getting them right might help keep your money working for you. Our latest guide, Understanding RMDs, breaks down how they work, when to take them, and strategies that may make them less of a tax headache and more of a financial opportunity. Request your copy today by calling 800-393-4001 or by visiting ArmstrongAdvisory.com. That number again is 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping and the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served nearly 20 years, and we are so proud to have him and his business as a key partner and a presenting sponsor of the DAV 5K Boston. The DAV Department of Massachusetts does incredible work, and it's one of the first organizations that Mark became familiar with after his military service ended back in 1984. As Mark built his company, he knew he'd be giving back to fellow veterans who needed jobs, support services, medical supplies, and so much more. Mark works with disabled veterans every day, and it's one of the key reasons why he's such a big supporter of Dan Stack, the DAV Department of Massachusetts, and the DAV 5K Boston. You can join Mark Vonner and his team and make a donation to the DAV Department of Massachusetts or become a sponsor of the DAV 5K Boston. Simply visit dav5k.boston. That's dav5k.boston.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about the implications of gifting assets away. Todd, since the estate tax laws are projected to change on January 1st of 2026, significantly reducing the estate tax exemption, does it make sense to gift away assets right now?
You know, it's a big question mark. You have to think of a few things. One, look at the size of your estate. If the exemption falls to $7 million each and you're married, you can still die with $14 million of assets and not have an estate tax. So gifting might not be important from a federal gift tax situation. But the state exemption is only $2 million, so you can only shelter $4 million. So you might want to gift to reduce your state estate tax. However, there's basis to consider. If you give away low basis assets, you're trapping capital gain. And to do that, you might be paying more in capital gains taxes later when the kids sell the assets than you're saving in just Massachusetts estate tax. So you really got to think about whether it makes sense to gift or not. And if you're going to gift, you should probably set up a gifting trust. People might be gifting large assets away and not gift the assets directly to a child. Have them in a trust for the child's benefit and then protect those assets for them.
Educate yourself about the implications of gifting your assets away. Request your free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699. That's 866-848-5699. Or you can request a copy from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, markets are extending gains from yesterday's rally as the Fed kicks off its two-day meeting, followed by a rate decision on Wednesday. Traders are also waiting for a big batch of big tech earnings and a potential China trade deal later this week. Right now, the Dow is up by 0.4% or 183 points. S&P 500 flat at the moment. NASDAQ up about 0.25% or 55 points. Russell 2000 is down 0.2%. 10-year Treasury yield is down 1 basis point at 3.979%, and crude oil down 2% today, trading right around $60 a barrel. Amazon announced that it will lay off about 14,000 corporate jobs, marking the largest round of corporate job cuts in the company's history. Reports indicated Amazon's layoffs are expected to affect as many as 30,000 corporate jobs. Amazon is up slightly. Meanwhile, UPS rallying 8% after the delivery giant posted better than expected third quarter revenue and raised its fourth quarter guidance. The company also said it has reduced its management workforce by about 14,000 positions so far this year, and its operational workforce by 34,000 positions. Elsewhere, Microsoft and OpenAI finalized a new agreement where Microsoft will get a 27% ownership stake in OpenAI worth about $135 billion. Microsoft is up about 2% today and has surpassed $4 trillion in market cap. Apple also crossing that mark today. PayPal shares are climbing about 11% after the digital payments company beat third quarter earnings and announced a new e-commerce partnership with OpenAI. Wayfair surging 22% after the online furniture retailer posted stronger than expected third quarter earnings. And after today's closing bell, Visa will report its third quarter results. I'm Tucker Silva, and that is Wall Street Watch. And we haven't done trivia yet, so let's get to it. On this day in 2021, Mark Zuckerberg announced Facebook will change its corporate name to Meta amid increased public scrutiny over leaked internal documents. So our trivia question today, what year did Mark Zuckerberg launch Facebook? Once again, what year did Mark Zuckerberg launch Facebook? Be the fifth person today to text us at 617-362-1385 with the correct answer, and you win a Financial Exchange Show t-shirt. Once again, the fifth correct response to text us to the number 617-362-1385 will win that t-shirt. See complete contest rules at financialexchangeshow.com.
The, whatever you want to call it, the halo effect or the Midas touch in the AI sector is at least continuing to play out today. I know Tucker mentioned a couple of these, but I just have to highlight this for a moment. PayPal announces a deal to be the payment processor for OpenAI. Stock jumps 11%.
Mm-hmm.
Nothing's been realized. They haven't implemented it. They haven't gained any revenue, but stock's jumping 11%. Microsoft is announcing that there's some clarity in terms of their ownership structure of OpenAI. Stock's jumping 2% on a $4 trillion company. Nokia, as we just talked about, some partnership with Nvidia. It's going to be some sort of equity investment into Nokia by Nvidia. Stock's jumping, what was it, 14% on the news? Again, not to say that any of these are completely out of line, but my read on this is everyone is being treated as a winner in the AI space. There are no losers right now if you have a business that is interacting with one of these major players. And one thing we know is that that's usually not the case. Usually, not everyone is a winner. Unless you were a millennial playing soccer in the 1990s. But other than that...
I'm sure that probably still continues today, I would imagine. I'm early in my soccer coaching career, but I think it's going to trend that direction.
Everybody gets a ribbon.
Not that I wanted to, but... And also, all against a backdrop, Mike, of a company who is not public. You know, isn't it like that?
Open
is
AI,
that
not publicly traded.
They're at the forefront of this revolution. I mean, Nvidia is right there with them, and there are other players too, but the seminal product on AI is ChatGPT from a company that is not public. It's fascinating, the tentacles of OpenAI and the fact that it has grown so big and is still not a publicly traded company yet.
The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences have put the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping in the world-famous Magens Bay. St. John is pure escape, with national park hikes, secluded beaches, and tropical tranquility. And St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of America's Caribbean paradise. Visit usvi.com and book your trip today. That's visit usvi.com.
There's a piece from Justin Fox in Bloomberg about how the AI stock boom plays out. Unfortunately, for all of us out there, he does not have any insight into when it plays out or what happens to the stock market as a whole in terms of pricing. But he puts together basically a pretty convincing argument to me, which is as the economic significance of artificial intelligence becomes clearer, the valuations of those companies, price to earnings, price to book, price to, all of these things will fall.
Mm-hmm.
And it's because when you are dealing with something that is so new and emerging, you don't honestly know how productive it will make the economy. And so what you have is speculation.
Mm-hmm.
You have some people betting, well, this is going to make this company 10% more productive, and therefore I'm going to, even if there's plenty of people that are saying, no, it's only going to make them 1% more productive, you take the averages there and you're saying, oh yeah, this company is going to become that more productive and that more profitable. The answer is that we don't have a real firm idea of how all this is going to work. And so his point is, as it becomes clear, valuations fall. Now, valuations can fall in two ways. Price can come down, stock prices can come down, or these companies are so productive that their earnings go up.
Mm-hmm.
And in either case, the valuation in those cases does fall. And he's not coming out and saying, I know which one's going to happen here. But it is a interesting take on all this and why we do focus on that piece quite a bit to say, oh yeah, we are in the 99th percentile ever in terms of stock valuations. We are in a moment right now where the only time that stock valuations have been pricier was in the late 90s leading up to the dot-com bubble. It is because of that mere fact that, hey, there is just so much unknown about this emerging new thing that everyone is so excited about that there are speculators all over the place, trying to determine and trying to bet on who's going to be the winner and how big of a winner they are going to be. And naturally, as you learn more, there will be less speculation, because that's inherent in the idea of speculation, is you're betting on something that you can't possibly know.
Exactly. I thought it was a great framework to sort of lay out the case where basically with this next technological innovation, the range of earnings growth that could be promised from it is so wide. I mean, it could be minimal, into which his point, valuations will have to come crashing down if you don't see a significant amount of productivity enhancements and earnings growth, but you could see it on the other end where you see tremendous earnings growth. And it's much harder to make a clear determination from a valuation perspective where some of these companies should fall, because you just don't know with this technology what the earnings growth rate is going to be. It is much easier, for example, to look at a real estate deal where you have a multifamily building and you know how many tenants you have and you know how much rent and vacancy that you could have. Right. The variables are much more controllable these are the amount of people I can fit in this building and this is the rent I will charge them. Where you're talking about this, the earnings growth that you can have is just far more variable and harder to assess. And that's why you see the speculation and the build-up and the buy-up of price-to-earnings valuations here, because so much, like you said, is hard to gauge which side it's going to fall on.
Let's take a quick break. When we come back, we'll have the trivia winner and Stack Roulette.
Hear the Financial Exchange every day from 11 to noon on SiriusXM's Business Radio Channel 132. Keep it here for the latest business and financial news and the trends on Wall Street. The Financial Exchange is now live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
Hi, this is Chuck Zada from the Armstrong Advisory Group. Required minimum distributions, or RMDs, may seem simple, but there's a lot more to them than just taking money out of your IRA. RMDs impact how much you pay in taxes, and they can push your income into higher brackets. And if you miss one, the penalties can be steep. They also affect how much your heirs actually get to keep, which makes timing and strategy crucial. If you have multiple accounts, it's important to know which ones you can combine and which ones you can't in order to help you avoid costly mistakes. Our new guide, Understanding RMDs, shows you how to navigate the rules, limit your tax burden, and plan ahead for your legacy. Request your copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Cushing & Dolan want to help you avoid costly mistakes when it comes to gifting assets to your children. Their brand new guide, Making the Most of Gifting Assets, shares crucial strategies to help you protect your legacy and your family. Many people think gifting is always a good thing, but if it's done the wrong way, it can create real headaches. Even well-intentioned gifts can cause complications if your children are dealing with financial pressure or legal issues like a divorce. The guide also explains how a major gift, like a home or vacation property, could come with hidden tax consequences that may impact your entire estate plan. Before you make any big moves, arm yourself with the facts in this new guide from Cushing & Dolan. Call 866-848-5699 right now to get your copy. That's 866-848-5699. Or request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping in the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
The Financial Exchange streams live on YouTube. Subscribe to our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
Trivia question today was, what year did Mark Zuckerberg launch Facebook? That would be 2004. Mike from Lebanon, New Hampshire is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Mike. And we play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Time for a bit of stack roulette here. Paul, what do you have for us this morning?
Nextera and Google are making an attempt to revive a major nuclear facility in Iowa as AI energy demand surge. This is something that we talked about on the show a lot. There is going to be a tremendous amount of computing power and electrical power that is required as part of the billions of dollars that these major companies are spending to build these data centers across our country. And as a result of that, nuclear energy has become much more in vogue. And so this particular plant was decommissioned back in 2020, but they're now setting it up to try and get it back online in 2029. And the one question that comes to mind is, you know, we're in a huge competition with China to become the leader in terms of AI and the technology and how it evolves and hopefully become the front runner in that space. And there's a huge disparity in terms of the power generation that China has versus the U.S. in terms, obviously, there are some negatives that comes with China and just how they can put this power online without any regard for human life or, you know, the environment or anything like that. But we got to wait 4 years, 3 or 4 years to get this thing online. There needs to be a little bit more regulation that is, or legislation maybe, that's stripped back, and we need to be a little faster with this.
I keep going back to this China-U.S. AI race as a theme that's not really discussed or appreciated. And I think there's good reason for why it's not discussed, because nobody truly knows, but on the energy side, it's measurable, right? Like I haven't done it, but I'm sure somebody has measured the current electricity capacity in China versus the United States, and also measured the pace at which new stuff comes online there compared to the U.S.
They're doing more than 10 times this year than we are in terms of, I think it's gigawatts.
Paul's measured it.
No, I've read something that has measured
but
it.
Like, that is measurable. What is not measurable is just how far ahead U.S. chip design is compared, and generative AI models, how far ahead that design is compared to China. We have some sense that we are far ahead. We know this by the fact that China keeps trying to illegally import our latest and greatest semiconductors and chips in order to design their own models. But that part nobody can really measure for me. Hey, are we 3x more efficient and more capable than China when it comes to chip design? Are we 1.5x? Because here's where the rubber hits the road, right? Like, the reason that we are making and designing these latest and greatest, faster and faster and more efficient chips is to be able to implement them in the United States, where we don't have the same power generation. And if a lot of that just comes down to efficiency, how much power do you need to generate the same level of artificial intelligence computing power, then I think we're kind of screwed.
Mm-hmm. Mm-hmm.
And I'm not saying that that is the case, but there does not seem like any seeming willingness in the United States to catch up to China in terms of the pace at which they can bring on energy infrastructure.
No question.
And so I don't think that it all just comes down to efficiency. I think it also comes down to speed and other factors when it comes to these chip designs, as well as the AI models themselves. And I hope that the American edge when it comes to tech innovation and ingenuity, and just that edge that we've always seemed to have against other countries when it comes to designing this stuff, and maybe it's because of institutions, maybe it's because of more freedoms, and that stokes the creativeness. But if all of it just comes down to who can throw more power at the problem, China's going to win that game.
Definitely, but
especially at least any time in the next decade.
Right.
They will far surpass us in that one game. So are we able to out-innovate them faster, out-innovate and prevent them from then stealing
ripping
those
it off like
technologies.
they have always?
It's a multi-trillion-dollar question. Let's see here. What do we want to talk about? Let's talk about Airbnb. Airbnb wants to prevent Halloween parties in the United States and Canada, and next, they're canceling Christmas. That's actually not being reported. But Airbnb does have a real problem here where
Halloween's on a Friday.
Halloween's on a Friday, so people are going to be extra sloppy. But really, the bigger problem is young people who want to throw a massive party and do not have the space in their 400 square foot apartment to do so. What do? You get a bunch of people together and throw a bunch of money at an Airbnb and trash that place instead. So they're implementing some innovative new ways to go about this, but they are taking a look and blocking guests, from booking certain properties based on the timing of the booking,
their age,
how far away the booking is from their place that they're inquiring about it, right? So if I live in Boston and I'm searching for a place to rent in Cape Cod, then they're taking a look at that and saying, okay, interesting. You're booking it for 2 nights around Halloween. That's an interesting timing request here. So last year, the company said it prevented about 38,000 people in the United States and 6,300 in Canada from making bookings during this time period.
How what percentage we're actually throwing a party is beyond me, but maybe they have good enough data where they're able to sort that out.
Yeah, look, I know that this is a serious problem for them. I don't really know how much of this falls on Airbnb compared to the owner of the property who's listing it and saying, "Hey, I'm comfortable with you renting it out over Halloween." Like, if I'm genuinely worried about this sort of thing, I'm probably just saying, "Hey, I don't want my property to be trashed, so I'm not going to rent it on this."
Or
weekend.
you extend the amount of nights, right? That would box out someone who's trying to do this. You say, "Okay, you can rent during the time period, but it's got to be 5 nights." No college age or younger person is going to commit to 5 nights of a rental rate just to throw one-night party, unless they have a real big bankroll, I guess. But you'd think that would sort of cut it off at the head.
So my question then is, why isn't Airbnb in the business of
having parties,
having Halloween parties, right? If they're going to prevent all of this stuff from happening, they know there's demand. Talk about a business model. Okay, you need to start renting out locations that you can throw a party, not piss off all the neighbors, and charge all these college kids a whole bunch of money. And
I'm sure Airbnb executives could throw thousands of lawsuits at us to explain why they don't want to be in that game from all of the issues that they've dealt with over the years that I'm sure would make our heads spin.
Yeah. I guess just go look at.
I guess some of these listings have noise meters inside.
Wow.
Like to track the decibels. Yeah.
Don't rent it to my family.
Yeah, what if my family's just loud?
Yeah. Be quiet! The noise meter!
My baby can't sleep.
Markets are open and remain in positive territory. S&P barely hanging on to gains here for the day, but the Dow and NASDAQ up 0.33% each. Big day tomorrow with Fed meeting at 2:30 plus big earnings reports after the bell. We'll be back at it tomorrow, folks. Have a great rest of your day.